Welcome, everyone, to another deep dive. This time, we're diving headfirst into the world of market manias. And trust me, it's wilder than a roller coaster ride. We've got our hands on some fascinating research excerpts from two really insightful books. One, a deep dive into the history of market bubbles.
And the other, believe it or not, a look at popular delusions throughout history.
Because, when it comes to the market, whether it's tulips or tech stocks, we humans have a knack for going a little, shall we say, overboard. Our goal today, to uncover the driving forces behind these wild market rides and, more importantly, how we can avoid getting caught in the crossfire. After all, history has a way of, well,
Repeating itself, especially in the financial market.
exactly. And trust me, some of the stories in the annals of market bubbles are about as wild as it gets. I mean, did you know that centuries before the stock market even existed, people were already losing their shirts over, of all things, tulips?
It's true.
Yeah.
Tulip mania of the 1630s, it's the perfect example. Imagine folks throwing down their life savings for a single tulip bulb. Some even hosted these, get this, elaborate tulip feasts.
Wait, seriously, tulip feast, that's both hilarious and kind of terrifying. What were they thinking?
Well, tulips were the new kids on the block in Europe back then, seen as these exotic, luxurious commodities. People were convinced their value would just keep skyrocketing,
So instead of, I don't know, investing in some good old-fashioned farmland, they were betting it all on a flower.
basically. And that's a pattern we see over and over again in these market manias. It doesn't matter what it is. Unbridled speculation, this unshakable belief that prices will just climb forever, totally detached from, common sense.
And that's where things get dicey, right? When that fear of missing out kicks in.
Absolutely. And suddenly, everyone wants in on the action, sending prices even higher, fueling that frenzy, like a game of musical chairs, and nobody wants to be the one left standing.
And that crash after the tulip mania, that was pretty spectacular, right?
To put it mildly, fortunes wiped out, practically overnight. People who thought they were sitting on a gold mine, suddenly drowning in debt, all because they bought into the hype.
And it wasn't just tulips, right? Our research mentions a whole bunch of other examples. I mean, the South Sea Company bubble back in 18th century Great Britain, now that one was something else.
Oh, absolutely. At its peak, that company was valued at 5 times. 5 times the entire GDP of Great Britain. Staggering, even by today's standards.
5 times the GDP of Great Britain on, what, trading ships and pure speculation.
Pretty much. They were selling shares, promising unimaginable riches from trade in the New World. But in reality, it was all built on hype.
Okay, so we've got tulips and trading companies centuries apart, but the same patterns keep popping up. So is it just human nature to get swept up in these crazes?
There's something to be said about the human element in all of this. We like to think we're rational beings, but our brains,
Hmm.
wired to seek patterns. And sometimes, well, we see patterns where there are none.
Like connecting the dots when they're not even really there.
Exactly. And that tendency to see patterns, especially in the financial world, well, it can lead us down some very interesting paths.
So we've got these patterns, these market manias popping up all through history, but what is it about our brains that makes us so susceptible to these speculative bubbles?
Well, it's not just about recognizing patterns, right? Our brains, they also crave a good story. And sometimes we get so wrapped up in the narrative and all hype that we completely miss those red flags waving right in our faces.
Like the classic tale of striking it rich quick with the next big thing, even if that thing is, well, a tulip bulb or some random company with a .com slapped on the end of its name.
Exactly. And that's where these cognitive biases come into play. Think of them like mental shortcuts our brains use to process information faster. But, and this is the important part, they can also lead us to make some, shall we say, irrational decisions.
Mental shortcuts, huh? I'm all for saving time, but not if it means kissing my savings goodbye. So, what are some of these biases we should be keeping an eye out for?
One of the big ones is what we call hindsight bias. That sneaky tendency to look back and think, oh, yeah, I totally saw that coming, even when, in reality, we probably didn't.
Oh, tell me about it. I'm super guilty of that one. It's like when you swear to your friends you knew that underdog was going to win the championship, even though you had absolutely no clue.
Exactly.
Hmm?
And, our research mentions this fascinating study done after the 1987 stock market crash. A Yale economist, he surveyed a bunch of investors, and what do you know? Many of them claimed they had predicted the crash. But when he actually looked at their trading records,
Let me guess, their actions told a slightly different story.
you could say that. It was like they were rewriting history in their minds, trying to make themselves look smarter after the fact.
So hindsight bias, it can make us overconfident, make us think we have some crystal ball when it comes to the market, when in reality, it's more like, well, playing the lottery.
That's a good way to put it. And then there's our love for a good gamble. Our research actually uses the example of betting on horse races. You see, statistically speaking, betting on the favorite, the one with the best odds, that's the more rational choice. But
But it's not nearly as exciting as placing your bet on that long shot, that underdog nobody thinks has a chance.
precisely
Yeah.
because that potential for a huge win, even if it's a long shot, it speaks to our inner thrill seeker. That deep-seated desire for a big win. And that, my friend, can cloud our judgment, even when we know the odds are stacked against us.
It's like that old saying, high risk, high reward. But maybe in the world of investing, it should be high risk, high chance of ending up with empty pockets.
Something like that. And this whole desire to get rich quick, well, let's just say that mentality can be pretty dangerous when it comes to investing.
Okay, so we've got hindsight bias making us overconfident and our inner gambler pushing us towards risky bets. Anything else lurking in the shadows of our minds that we should be aware of?
Oh, you better believe it. There are plenty more where those came from. And some of them are actually, well, hardwired into us from our evolutionary history. Think about it. Way back in the caveman days.
You're talking about our fight or flight response.
Bingo. Imagine you're a caveman, just strolling through the woods, and you hear a rustle in the bushes. What's your first thought? Is it the wind? Or is it a saber-toothed tiger about to pounce?
I don't know about you, but I'd rather run for the hills, even if it was just the wind, than risk becoming a tiger's afternoon snack.
Exactly. And that's the thing. Back then, overreacting to a potential threat, even if it wasn't real, well, it was a survival strategy. But in today's world, those same instincts, they can lead us to make some pretty impulsive financial decisions.
So it's like our caveman brains haven't quite caught up with the complexities of the stock market yet.
That's a great way to put it. You see, those deeply ingrained instincts that helped us survive back then, they aren't always the best guide for navigating the world of modern finance.
Like trying to use a stone axe to build a skyscraper. So how do we balance those primal instincts with, making smart, rational financial decisions in the 21st century?
Now that's the million-dollar question, isn't it? We need to understand these biases, these mental shortcuts, so we can recognize them when they start creeping into our decision-making process.
So it's kind of like having this mental checklist, something to help us spot those irrational impulses before they lead us down the wrong path.
Now you're getting it. And, one of the most powerful tools we have at our disposal is simply awareness.
Awareness of our own biases and how they might be influencing our decisions.
Exactly, because once we start to recognize those biases, we can start to develop strategies to counteract them. But that, my friend, is a conversation for another time.
Okay, so we've got these caveman brains trying to navigate the wild world of modern finance. But how do these biases actually play out in real-world market events? Can we connect the dots, so to speak, between our ancient instincts and, say, the dot-com bubble of the late 90s?
Oh, absolutely. The dot-com bubble, it's a textbook example of how our collective desire for, well, a quick buck, fueled by all that hype surrounding a brand new technology, it can lead to some, let's just say, irrational exuberance in the market.
Because everyone and their grandmother wanted a piece of that dot-com pie,
Yeah.
even if they didn't really, understand what these companies actually did.
Exactly. It was the dawn of the internet, and there was this feeling that the sky was the limit.
Yeah.
Right? And traditional valuations, out the
Sure.
window. Companies were being valued based on potential, on dreams, not on your actual profits or tangible assets.
And let's not forget about all those companies scrambling to add .com to their names just to ride that wave of excitement, even if their business had absolutely nothing to do with the internet.
Pure marketing genius. Really. They were tapping into that fear of missing out, that herd mentality that just drives these market bubbles. Suddenly, every company wanted to be seen as part of the new economy, even if it meant, well, stretching the truth a bit.
And then, of course, the bubble burst. And a lot of those .com dreams turned into, well, financial nightmares.
As is often the case with these market manias. Because the problem is when prices are driven by speculation and hype, they become, detached from reality. Eventually, gravity takes hold, and boom, the bubble bursts.
And we see those same patterns repeating throughout history, right? It's like we never learn.
Well, we do learn, but sometimes our emotions, they just get the better of us. Take the 2008 financial crisis, for example. Now, that was a complex event with a lot of contributing factors, but one of the key drivers The availability bias.
The availability bias. Remind me what that one is again.
Sure, it's basically our tendency to overestimate the likelihood of something happening based on, well, how easily we can recall similar events from the past. So after the collapse of Lehman Brothers.
Which was, I mean, it was huge, right? Constantly in the news.
Exactly. It was everywhere, all over the media, seared into everyone's minds. And as a result, investors, they became, well, overly fearful, overestimating the likelihood of other banks failing. And this led to a freeze in lending, which, of course, just made the crisis even worse.
So, in a way, our brains were hardwired to overreact based on a recent vivid memory, even if it wasn't necessarily, representative of the bigger picture.
Precisely. And it all circles back to those caveman instincts we were talking about. You see, our brains, they're still wired to prioritize immediate threats, even if those threats are, well, more perceived than real.
So, how do we break free from these ancient biases, these mental shortcuts that seem to trip us up time and time again?
Awareness is key, and understanding our own emotional triggers. When we can identify the biases that are most likely to influence our decisions, that's when we can start to develop strategies to, well, counteract them.
So, it's about having a mental game plan, a way to anticipate those moments when our emotions might lead us astray.
Exactly. And part of that game plan, taking a long-term perspective. Remember, the market, it moves in cycles. There will be ups and downs, periods of euphoria, and yes, periods of panic.
It's like riding a roller coaster, right? You've got to hold on tight and ride out those gips.
That's a great analogy. And just like on a roller coaster, jumping off in the middle of the ride, probably not the best idea. Keep your investment strategy focused on the long term. Don't let those short-term fluctuations derail your goals.
So don't panic and sell everything when the market takes a dip.
Exactly.
Yeah.
Remember, the people who really succeed in the market, they're not the ones trying to time every rise and fall. They're the ones with a solid strategy, who understand their own biases and who stay the course, even when things get, shall we say, a little bumpy.
This has been a fascinating deep dive into the world of market manias and the cognitive biases that drive them. We've learned that while we may never be able to completely eliminate these biases, simply being aware of them is a huge step in the right direction.
Absolutely. By understanding these mental shortcuts, we can make more informed, more rational decisions, even when the market feels like it's turned upside down.
So the next time you're tempted to make a rash investment decision, take a moment, ask yourself, is this really the logical choice? Or am I being swayed by my inner caveman?
That's a great question to keep in mind. And remember, knowledge is power, especially when it comes to your finances.
Thank you so much for joining us on this deep dive into the fascinating and sometimes, let's be honest, a little bit crazy world of market psychology. We hope you've learned some valuable insights that'll help you navigate the markets with more confidence, more clarity, and maybe, just maybe, a little less stress. Until next time, happy investing.